Good morning, everyone. Welcome to this update for global stocks and commodities for the 20th of January. The rebound continues. So we had an absolute smashing in the early part of December, leading into Christmas, the worst since 1929. And now we've had 3.5 weeks of pretty strong rebound. So obviously it begs the question, where to from here? I'm still of the view, just based on probabilities, not because I have a particular leaning either way, but more than 80% of the time, when you get a sharp sell-off and then a rebound, we see a retest. So that means that somewhere between 8 and 9 times out of 10, we would expect that after this rally has run its course, that we will get some lower market prices to perhaps retest down somewhere towards the lows that we saw on December 21. So one can really only go with the probabilities. So I think that's still the option to expect at this stage and to factor into your entry plan. So basically that's what I'm working on. So in this update, I just want to take a step back and just look at how much has really changed since the middle of 2018, when everything was really flying along. All the economic data looked good, prices were good. The US market set new all-time highs in September. So things really did look tremendous, and then they very rapidly fell off a cliff. So we've now got a whole lot of price action that we can consider and try and put into context. So new all-time highs, large correction, and then we've had a very sharp rally with the probability that we'll get another down leg in the very, very near future. Now, from my perspective, the prices are moving a huge amount more than the fundamentals are moving. Yes, China is weakening, but they're starting a stimulation program that always pays benefits for China because they can do things that Western democracies can't do. The fallout from Brexit is still not really quantifiable. No one's got any idea whether we're going to have a hard Brexit exit or some sort of deal negotiated. So you can't factor that one in. You've just got to leave that on the table. Europe is sort of limping along okay. But look, in America, things are pretty good. It's early days yet for the new earnings season, which has only just started. But already the earnings per share growth rate for quarter four is 10.6%, which is okay. It's not 25% we had last year because of the one-off impact of Trump's tax cuts, but 10.6% is still pretty good at such an advanced stage of an economic expansion. And the financial results, which were the ones reported last week, particularly Bank of America, were tremendous, well in excess of what the market expected. So things are going along in America pretty well. I'll come back to that in a minute. And so Portfolio Analyst last week, I'm really just all about finding lower risk growth opportunities because at the moment we don't really have a trend. We've just got a huge amount of volatility that net is not going anywhere. And so therefore you really want to look for opportunities to make some money where you can manage the risks to a relatively low level. So that's what I'm really focusing on in Portfolio Analyst. So the American stocks, the index ended up another 2.9% for the week. Markets really started seeing a different global outcome if we go back to the middle of last year or particularly August, September. They started perceiving that there was going to be a different global outcome, perhaps a slowing, and they overreacted. It's as simple as that, as they tended to do. The market should never have gone down as much as they did, but that's the reality of modern day markets. The lack of liquidity leading into Christmas had some impact. It was certainly flamed by computer algorithms. I think there's little question about that, combined with the lack of liquidity, and that just caused that massive overreaction. So now we're in the process of finding a new lower balance point in the market based on the perception that things in the future are not going to be as good. And no one knows whether that is true or not. But as I said at the start, the actual facts and the data in America are still pretty good. It's just not that bad at all. And jobs growth is still accelerating. So there's no way known that you're going to get a recession when jobs growth is still accelerating. Now, yes, China's got issues, and yes, the UK and Europe have got some issues, but there's always issues. So my overall view, now that I've had a chance to sit back and look at a few more weeks of activity and get some more data under my belt, is that I think the sell-off that we had was a significant overreaction. I think some sort of sell-off was probably fair enough, but it was an overreaction. We're getting a rebound. We'll probably get a retest of some sort, probably to a higher low, and then we'll get on with it as the markets seek to establish a new balance point. The US dollar was higher on the week, particularly into the end of the week, and the US 10-year Treasury yield is slightly higher to 2.78, and the spread between the 2-year and the 10-year bond yields has started inching up again. Now it's almost up to 0.2, so all the people that slip their wrists over a yield curve inversion are having to eat some humble pie, I think. So let's jump in and take a look at the charts. And we'll start with the S&P, and you can see here was the initial sell-off that started in October. So we went down, an ABC correction, first leg down, little bounce, third leg down, and then we bounced around. So until the 14th of December, that was all exactly as one would have expected. And then Jeremy Powell made his comments about the fact that their reduction of their balance sheet, their bonds on their balance sheet, was on autopilot and therefore was going to happen anyway. And people freaked at that. The lower liquidity leading into Christmas, computer algorithms, etc., all took over, and we got this almighty smashing that took us down to 23.50. But then cooler heads prevail, and we get a massive turnaround, and we've gone straight back up again. Now, as I said, I'm expecting a retest of these lows. The higher this goes and the longer this goes, then the more I'll feel that this low will be, instead of being down here, which is where I've got this green box that I put in there last week. So I thought that was the possible range that we would retest to, and maybe we will. But if this keeps going for a few more days, and it's certainly being helped along by the fact that there are noises coming out of Washington that they may be easing off on the trade tariffs, then this green box might move up to here somewhere. So we'll just have to wait and see. So that's the S&P. If we look at the small cap end of the market, the Russell, it's also rebounded quite nicely as well. But still a time for a bit of caution, because we've gone down to an oversold extreme. We've now gone to an overbought extreme, and I think we'll bounce around here for a while and form some sort of range in this area between those 2 points, I think, is the most likely outcome. US dollar, we had a decent dip from the start of December, and of course now markets have been very much improved by the fact that the Fed has really backed off significantly, and that certainly helped the market turn around as well. While I'm here, let's look at the Australian dollar. The Australian dollar, you can see we did have a bit of a dip under 70 briefly for a day or two, but we're basically in this range between 70 and 73 seems to be the range at the moment that we've settled into. Now, if we look at the overall Australian index, quite a strong rebound as well in the Australian index. So it's really just following along in global terms. Percentage-wise, didn't really go up as much as the US market did. So we finished 71.7, and the ASX was up 1.8% for the week. And as I said last week, and this has been the case for some time, my focus remains very much on heavily undervalued growth stocks in the top 200 in Australia, but with the emphasis on undervalued and growth stocks. And also the large cap stocks in America. So there's very, very little that I'm looking at or tracking in America that has a market cap less than about $50 billion. So I've certainly moved down the risk scale, that's for sure. And I'm also still very keen on the growth microcaps. I know that they've had a hard time in Australia in the last couple of months, but the businesses themselves are going along really nicely. And we saw 3 announcements among 3 of my key stocks that members will understand which ones they are. They all provided market updates last week. They were all tremendous market updates in terms of the growth of the business and the forward outlook, and prices responded accordingly. We saw some 15% and 13% gains on Friday in a couple of them, and I've still got high hopes for these growth microcaps in Australia. But you certainly need some patience. You need a very clear game plan. You need a bit of a strong stomach for the shorter term fluctuations, but the long term outlook is tremendous. And some of these stocks are going to go on and make multiple 100% gains over the next couple of years. So I'm very excited by that part of the Australian market. Okay, let me just quickly look at precious metals now. So gold was down $7 to $12.81, and I think the large part of that is that risk-on sentiment has come back again. So gold does well under 2 circumstances. One, where apart from the relationship with the US dollar. So if the US dollar goes up, then gold's going to go down. But putting that aside, the currency relationship, gold will do well under 2 circumstances. That is where people aren't expecting interest rates to go up very much, and also where there's some fear. So those 2 things together are very good for gold. The fear is disappearing, the risk-on sentiment is back, and gold is going down a bit. But that doesn't mean we can't make money out of the sector. Now, the global majors were down on the week. The Aussie gold producers still well overbought, so they'll probably cool off on the early part of next week with a lower gold price on Friday night. So let's look at gold. This is gold on a daily basis, so you can see we had a nice triangle forming here over the previous 10 days. Nice little wedge-shaped pattern, and we dropped out of that very short-term wedge quite emphatically on Friday. So I suspect now that gold will head a little bit lower. We'll probably head towards the 12, perhaps the 1250 to 1270 kind of area in this little area here. But there's no question that we're in an uptrend. And we were a bit overbought. So the uptrend really started in August. We got overbought. We had a little triangle form. It's resolved itself to the downside. That'll almost certainly follow through for a bit. But if you look at the medium term, we are in an uptrend in gold. So, you've got to remember that in terms of your strategy around the gold market. If we look at GDX, then stocks came off a bit on Friday, but not as much as the actual gold price did. So that's encouraging. I think we're seeing better signs in the gold market, and certainly in the Australian gold market. Other commodities, copper didn't move. Crude oil continued to rise, up another 3 or 4% to 53.8. So it's now an 18% rebound in the last 3 weeks from a very deeply oversold position. Now, again, in keeping with what I said earlier about going down the risk scale, then I'm really focused on the majors, the super majors. The members will know that I've been certainly looking at ExxonMobil. No real secrets there. I think when you get those sort of stocks sell off as they did, then it presents a pretty good opportunity. There's the 6-month copper chart, and the LME stock level is still really lurking around the base of the 5-year levels. There's crude oil. You can see we got down to under 43. We've now rebounded to 50, nearly 54. So it's been massively volatile in the last 3 months. So wrapping it all up, what is so important, and I hope really evident out of the last few months from October, which has been a difficult, challenging period, but you've got to try and avoid thinking like the herd that reacts to the selling, sells at the bottom in panic, and then when the market starts to go back up again, they start buying again when they feel comfortable. And of course, that's almost exactly when we're going to get some sort of retest down. So you've got to avoid thinking like the herd. Don't do things that feel comfortable or feel right. Often your best investments are going to be when you feel uncomfortable. And it's a difficult task to do it because our psychology is not wired that way. We are wired to feel comfortable, to try and step out of the way of danger. And the first thing to do is to recognize that that's how we're made up. And therefore, you've really got to be aware that you've got to put yourself out in a bit of a psychologically uncomfortable position if you want to do well in the market. But it's absolutely essential. You need to get interested. You need to train yourself to do this. When others are panicking, you really want to get interested in the market. Force yourself to go and look for opportunities. And if you don't know how to look for opportunities, then find someone that can help you with it. But basically, you're the ones that have got to start with the attitude that, when things are nasty, you should be smelling opportunity, because that's the way that it always happens. Clarity of your plan is essential. I keep banging on about this all the time, and I probably will until the day I die. It never ceases to amaze me how little effort most people put into getting really clear about their game plan. I guess it's because we don't like to be put in a bit of a straitjacket, and a plan tends to force us to do things that we may not want to do, but look, it's just so important. I am just so 100% crystal clear about what I'm doing at the moment with my game plan. It's fairly different to what most people would be doing. I know that for a fact because I talk to a lot of people, but I'm absolutely clear that this is the most appropriate strategy for the circumstances we've got at the moment and for probably the next few years. And I'm just sticking single-mindedly to it. Finally, you need patience for trends to re-emerge. We don't have a trend at the moment. We've just got massive volatility. We need to be patient for those trends to re-emerge. But you can do really well. And some of the Australian microcaps, the growth outlook for them over the next couple of years is so exciting. But you've got to be patient. Portfolio Analyst this week, I'm just, apart from the members' questions, Portfolio Analyst is just really an exercise, as I try to do for all of my memberships, of just finding low risk, solid reward opportunities. That's really what you should be focused on. Don't take too much risk, but you can still get growth without taking too much risk. It's not that hard. So that's it for this week. There's my contact details for anyone that's not a member, and I'll be back with you next Sunday. Look forward to another terrific week. Cheers.